Hey guys, what's up? I'm Erin and welcome back to the channel. Are we headed for another lost decade? In case you don't know, a lost decade is essentially where the stock market's returns are pretty lackluster. For a number of years, the stock market just stays pretty flat. Obviously, this is not good for investors. Investors put their money to work in the stock market with the hope of capturing a good return. They sacrifice today with the hope of growing their wealth. We don't want to be pumping our hard-earned dollars into a declining or totally stagnant stock market. While major news outlets like the Wall Street Journal and Fortune magazine are printing headlines warning of another lost decade, as the US stock market has taken a big hit in the first half of 2022. The S&P 500 is down almost 15% at the time of this recording. The Dow Jones is down about 10%, and the Nasdaq is down about 24%. First, we have to dive into exactly what a lost decade is. The origin of the coining of the term lost decade actually refers to the economic collapse that happened in Japan in the early 1990s. In the 70s and 80s, the Japanese economy was thriving. The Central Bank of Japan had kept interest rates artificially low, fueling speculation and sending the stock market and real estate prices absolutely soaring. It was a bubble. But as with most bubbles, it burst with major consequences. Most economic crises follow economic booms when the valuation of companies disconnects from the real value of these companies based on the fundamentals. And that's exactly what happened in Japan. Once the Bank of Japan had finally stepped in to take corrective measures, things had already spiraled out of control. And the consequence is not just a single decade of stagnant growth, but rather that the Japanese stock market is actually trading at less than its late 1980s high even today, 40 years later. While the term lost decade originally was applied to the Japanese economic crisis of the early 1990s, it has subsequently been applied to periods of low or no growth here with the US stock market. Most commonly, it's been attributed to the first decade of this century, starting in 2020. But by no means is that the one and only period of totally stagnant stock market growth. As a matter of fact, our nation has had a few of these decade-long experiences where the stock market returns have been pretty close to null. For the first period, we actually have to rewind back to the 1920s. Well, look at that. From 1928 to 1938, the stock market had a return of a negative 1.7%. From 1965 to 1974, the return was just 1.2%. And again, from 2022 to 2011, the stock market return was just 2.9%. Imagine investing for 10 years and getting a 1% return or a negative 1% return. When you look at it like that, it seems like it's not even worth investing at all. But if you look at this chart one more time, you see that the worst periods of time are often followed by wonderful decades of growth, bringing us back to the old adage of you can't time the market. You never know when the market's going to turn around, so it's probably best to just stay invested. But if they're predicting another lost decade ahead of us, what's the point? Why keep investing? Why scrimp and save and sacrifice today when there's no guarantee that tomorrow's going to be any better? Well, to answer those questions, we have to take a deeper dive into our most recent lost decade for those years following the year 2000. The S&P 500 was trading around 1,500 in the middle of the year 2000. And as we can see from this chart, it would then take a dive that it wouldn't recover from until 13 years later. It wasn't until early 2013 that the market was able to truly return and to surpass those previous 2000 highs. Those market charts don't tell the whole story though. The stated market return is only one piece of the puzzle. The other piece of the puzzle is dividends. And once you factor in dividends, that story changes a bit. Yes, from July of 2000 to February of 2013, the S&P only gave a stated return of 2.7% for the entire 13 years, which is pretty unimpressive to say the least. But once you factor in dividends, assuming you reinvest your dividends, that return balloons to almost 30%. Now, I know we're often told that the average stock market return is 10% per year. So if we get a 30% return over the course of 13 years, that really averages out to a little more than 2% per year. So should we really be that impressed? Well, let's throw some numbers into the mix and see how things would have panned out for different investors from the years 2000 to 2013. Let's say our first investor invested a lump sum of $10,000 in 2000, captured that average annual return of 2.1%. We're going to assume that he was a wise investor and opted to reinvest his dividend payments, and we will assume that he never invests anything else. His investment would grow to almost $12,600 over that 13-year period. Okay, I'll be the first to admit that that's not that impressive, but remember, this is a lost decade. Most importantly, most investors do not invest like this. Most investors do not make one lump sum investment and then never invest again. Rather, they dollar cost average, or they invest smaller amounts more regularly throughout time. They might invest on a monthly basis or perhaps on a bi-weekly basis in alignment with when they get their paycheck. Let's look at what would happen if our next investor took advantage of dollar cost averaging. Let's say that he too, like our first investor, started out with $10,000 in the year 2000, but he also contributes $500 per month over those entire 13 years. Well, that would grow to almost $100,000. That's a pretty significant difference. Yes, it's true that the investor here is doing the vast majority of the legwork. His contributions are, by and large, vastly responsible for that investment growth. Remember, he's only capturing a 2.1% return. But nonetheless, this is how investors typically invest. Even if we assume that we have an investor that starts with nothing in the year 2000, but invests $500 per month for those 13 years, they still end up with almost $88,000. Dollar cost averaging is what allows you to weather the market storms. You are buying no matter what the market is doing. If the market is down, you are still buying. Your dollars are going further and you're getting more shares for your dollars. When the market's up, you're still buying. You may not be getting as many shares, but you are still buying. Dollar cost averaging allows you to make the most of your money. Really, an unpredictable market favors the investor who dollar cost averages. When it comes to the lost decade, the investor who gets punished is the lump sum investor, the one who invests a lump sum right at the peak of the market and then never invests again. Now, of course, these numbers are not a perfect representation of how the S&P performed over those 13 years, because the S&P didn't give a neat and tidy 2.1% every single year. The market's a little more complicated than that, but it does give you a generalized idea of how the market would have performed for different investors. The moral of the story is you shouldn't throw in the towel on investing just because of fears that a lost decade is looming. Investing over the long haul pays off. And more importantly, who the heck knows what the next 10 years are gonna look like? One of the men making the prediction that the next 10 years are gonna look a lot like another lost decade is a man named Barry Bannister. And other than having a name that sounds like he came from a character in a novel, which is amazing, he's also a chief equity strategist at a St. Louis-based investment bank. Bannister has said, "Buy and hold is the ideal strategy in the bull phase, but in the down phase, being in the index is not going to generate a positive return. Investors who are passive are going to suffer." Of course, he's not a fan of passive investing styles. He's an equity strategist, which means that he picks stocks for a living. It's also worth pointing out that this is not the first time that Bannister has predicted a lost decade. He predicted that the year 2019 was going to be a recession year, followed by a lost decade back in 2018. Making accurate market predictions is next to impossible, no matter how credentialed you are. But if you make enough predictions, eventually you're bound to be right. But rarely does that mean that that person is adept to making market predictions. Rather, it means they got lucky. Yes, the market has rough years. The good years outnumber the bad. The only way to ensure that you capitalize on the good years is to simply always keep invested and keep investing. That is, don't cash out of the market and continue to invest over time. Whether or not we're truly headed for another lost decade, No one really knows, but the odds are you should be investing. What do you guys think about the future of another lost decade? Do you think we're heading for one? Let me know in the comments down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I hope you have a good one. I'll see you soon. Bye.